And David Doyle is North American economist and a strategist with Macquarie Group. David, always nice to see you. Thanks for joining us. What are you thinking about? I mean, what is top of mind for you as both an economist and a stock market watcher right now?
Yeah, John, I think what we're looking at is what are going to be the key drivers of risk appetite and market sentiment as we move into 2021. And the way our team sees it is right now in the real time, you have a bit of a tug of war dynamic at work where you have a positive force out there, which is that there's a vaccine coming on the horizon. We'll see how quickly it can be disseminated, how many people take it up. But unambiguously, that's a positive force and actually creates a bit of a light at the end of the tunnel theme for the market, I think, as you head into 2021. So overwhelmingly positive. And then sort of offsetting that and what's creating this near-term tug of war is, as you mentioned in your comments, the ongoing COVID spread, the severity in the U.S. and also in Canada and in Europe, increasing hospitalization pressures that are triggering, greater and greater government restrictions. Look, the way that we look at it is, markets tend to be forward-looking. The more dominant force over the next, 6 to 9 months is likely to be this vaccine story. And I just highlight every week that passes, we're getting 1 week closer to the point at which vaccine dissemination reaches critical mass, and there can be somewhat of a return to normal. And so I think every week that passes, that vaccine narrative will become more powerful. The virus spread is still there, which creates a bit of a tug of war phenomenon, as I said. But I think that will diminish over time in terms of how much that's holding back markets. So we're actually pretty positive, pretty bullish on risk appetite and where equity markets and broader risk assets are headed in 2021.
I want to dive into something that we're increasingly thinking about, and we saw it through the lens of retail sales today, which were better than expected, David, as you know, and we are seeing a lot of e-commerce activity. Now, if we were talking about lockdowns in certain hotspots in this country, and it was the spring, I think we would have seen big concerns on the economic front because there's just this great unknown. Now there's a lot more that we know. We know what's happening on the vaccine front. We know how much the government has to spend and can continue to spend. And we've also adjusted our own habits as consumers. So, a lot of people are already working from home. It's not ideal if we're not out and about and doing business as usual, but you're seeing that in the e-commerce activity. So do lockdowns in November, restrictions in November, have a different economic ramification than lockdowns did in the spring?
I think that's absolutely right, John. I think that there's a couple of things going on there. First, as you highlight, we as consumers have learned to adapt our behavior. So you're unlikely to see sort of the big declines in activity as a result as people were adjusting in that March and April period. Second, businesses have also adjusted, which makes it easier for consumers to buy stuff online and much more seamless. And then the third thing, which I actually think is much more important than even the first two, is that the restrictions being implemented are far more surgical and targeted than they were in March and April. Especially in Canada, we basically shut everything down, for 6 to 8 weeks. And I think governments have recognized, as they've learned more about how the virus has spread, that certain activities like manufacturing and construction, even some retail, can stay open safely even as the virus is spreading more rapidly. So you put all that together, and I think the restrictions will cause a slowing. They'll be subtracting from growth. But they won't be anywhere nearly as severe in terms of their economic impact and their drag on activity as what you saw in April and May. Absolutely, John. That's a great point.
Let's talk about the cash pile as well. That's been a big emerging theme we've talked about on BNN Bloomberg this week. The fact that as discouraging as it is that we're living through this second wave and how hard hit so many Canadians have been and Canadian business owners have been, that because all this money has come into the economy and we're also being cautious with that cash, you've got huge piles of cash in certain households and businesses that are sitting on a cash hoard as well. As both an economist and a stock market watcher, what does that mean to you?
Look, I look at this in the U.S. As well, and so when we looked at the U.S. consumer, for example, this week, we thought like their excess savings since the pandemic began is something like $1.4 trillion. I'm sure it's something of a similar order of magnitude in Canada, and I think what that creates is the potential for upside surprises from growth in the United States, in particular. As you move into 2021, and that's just because you could have this phenomenon where activity is returning somewhat to normal, and the consumer's behavior is returning somewhat to normal, and they have they already have an elevated savings rate, and then this big stockpile of cash. So you could see consumer spending do really, really well. I would say, in particular, in the United States, in the middle of next year. And I think that creates an upside scenario for economic growth. And it's part of the reason why at Macquarie we're expecting the U.S. 10-year Treasury yield to rise pretty significantly through the end of 2021. We're looking at something in the order of magnitude of about a 2% 10-year at the end of 21, which I think is just capturing the upside surprise that's possible from the U.S. economy in that year.
Really interesting. We'll see how that all plays out. David, thanks very much for joining us as always. Nice to get your perspective on this Friday morning. That's David Doyle of Macquarie Group with his economic perspective.